As Paul said, I'm working as a quant equity manager for more than 20 years. And I started doing research in equity, in factor models almost 30 years ago when I was a student in Karlsruhe. And there we had a large mainframe. And my professor at that point in time, it was in the mid-'80s, he started to collect stock prices from German Stoxx, and we had magnetic tapes and a large IBM mainframe, and we had to program it in COBOL and Pascal. But already at that point in time, 30 years ago, we started to analyze small cap, value, and low volatility stocks. And so over the past 40 years, this is something quants and the academic part of our industry has worked on very intensively. And when this whole issue of smart beta came up, maybe 5 or 6 years ago, we sat there at Quoniam and wondered a little bit what's going on here, because this is something that quant equity managers have done for decades. And I would love to hear Bar Rosenberg here today. He started his firm in the 70s, and he started to define risk factors based on value, size, beta, and momentum, so these are concepts that are very old. And as Paul said, I left Quoniam, and today I'm no longer in this business of factor investing and quant equity. And so Susan asked me to give a talk here today, a little bit to review and give some thoughts on what's going on here. But also, as I'm maybe the only speaker today who does not want to sell smart beta anymore, I can take a little bit more an objective or a little bit more a critical outlook. So the question is smart beta really that smart, inexpensive, and good for investors? And let me start to give a little bit a thought. What is beta all about? The word beta came up in the 60s when a couple of people invented the capital asset pricing model. And beta, in its original meaning, was the sensitivity of an asset or a portfolio to the overall market portfolio. So when the market portfolio has very specific characteristics. First of all, it's not a cap-weighted equity index. The market portfolio was the idea that in equilibrium, if we take all risky assets together, they form the market portfolio. And in this market portfolio, each and every risky asset is weighted according to its market value. And if we have on the one side all risky assets in these portfolios, and on the other side, all investors investing in risky assets, then in equilibrium, the CAPM says that each and every investor will only hold that market portfolio. And the CAPM further says that it's pretty clear that if this market portfolio contains all risky assets, it more or less captures our basic risk we have in life, which is economic risk. So systematic risk, beta risk is economic risk we all have per se. And this is why we should earn a risk premium. And the higher the beta, the higher the sensitivity of an equity, of an asset to this market portfolio, the higher the expected return. That was the idea of beta. It measures sensitivity to overall economic risk, and in theory, it measures sensitivity to the aggregate portfolio of all investors. So if you hold a portfolio with a beta of higher one, you would choose to hold a higher risk portfolio, and if you choose to hold a beta of lower one, you have a lower risk aversion than the average investor in the economy. So the market portfolio, the aggregate portfolio of all assets, and it's equal to the aggregate portfolio of all assets. So if you want to outperform the market portfolio, you need to outperform the average investor. And if you have a smart beta, you need to assume that outperforms the market portfolio. You need to assume that the average investor is dumb. That's pretty easy. If there are smart investors that have smart beta, you need to assume that some others are out there, especially those who hold the market portfolio, that are dumb investors. And I can tell you, from 20 years of trying to beat market cap weighted indices, in 20 years trying to achieve an alpha consistently each and every year, it's pretty difficult to beat the market. And we should not assume that the average investor is a dumb investor. I think the average investor is quite a smart investor. And so this doesn't say that there are strategies that will deliver outperformance, that are smart strategies compared to the market portfolio. But I think the whole term that there is smart beta, and all those who don't invest in smart betas are dumb beta investors, I think this is something that I have some problems with. Nevertheless, a market cap weighted equity index has really deficiencies. And for everybody who uses this as a benchmark, it's pretty well known. The basic problem is with a market cap weighted index as a benchmark or an investment vehicle is that each stock is weighted according to size. And that we measure size by the number of stocks times the stock price. And this is something strange, you know. Although we know the theoretical characteristics of the market portfolio, if I talk to friends, or think of yourself, you talk to friends, they ask you, I have 10,000 euros to invest, and you explain now what you are doing. So you take, for example, all German stocks, you take the number of stocks available, times the price, so you determine the size of a company by its valuation, and then you take the 10,000 euros and you invest along the size of a company. So most of your money invest in the largest stock and less of your money in the smaller stock. This doesn't make sense. You know, no matter whether it's dumb or smart, this is nothing that anybody who is not in the industry would say, this makes a lot of sense. Hey, I want you to overweight stocks that perform well and underweight stocks that do not well in the future. And I don't want you to invest according to the size of a company. So this is a big issue with the market cap weighted indices. And we, you know, and I'm a big fan of everything and a big promoter of every strategy that tries to mitigate that effect, that we do not invest our money according to the size of a company, because this doesn't really make a lot of sense. So we know that market cap weighted benchmarks are empirically inefficient. They are beatable. And we know the big problem that we allocate capital along the size of a company. And so smart beta, as already Sarah said, differ in two dimensions. So if you think of strategies that try to go away a little bit from market cap weighted indices, you have two choices to make. One is about the stock selection, which stocks do I include in my strategy, and second, about stock weighting. And I think the best the industry has done about all these things is to label them smart beta. They are supposed to be smart because they are built on well-known anomalies. And I have tried to put here the name and the year when, to my best knowledge, most of these anomalies have been published. So it was Horgan in the early 70s who found that low beta stocks performed better than high beta stocks. It was Bunz in the 1981, published his paper in 1981 about the firm size effect, Bazoo about the value effect, and Tscheka-Titman in 93 about the momentum effect. And of course, what really changed the landscape for quants was the paper by Farmer and French in 92. So you see, all that we are talking about today is something that's out there for decades. And to some extent, if you have been a quant in the 90s, especially in Germany, you were an outsider. no one talked to you, because we were very much inclined to talk to traditional managers and people who try to crunch data and analyze data and build portfolios built on data and all these things. They were a very, strange portfolio manager. And I think now with the smart beta industry and with indices provider offering these types of anomalies, I think it's finally the triumph of the quants, Finally, active quant equity, there's always been a smart beta investing strategy, and finally, everybody recognizes that. Having said that, why so much excitement now? And Sarah, I think, pointed to one important thing. It's my fourth point. When we started back in the 80s to analyze data, computing power was really expensive. And storing data was expensive, and getting data was very expensive. And today, everyone can become a quant. But this is not the major reason. I think the major reason was that for 20 years, our industry was very focused on one risk measure. That was tracking error. In the 90s, consultant took the idea of benchmarks into our industry, and from that point in time, all institutional portfolios were very much focused on tracking error. At Quoniam, we started our first low-vol equity strategy for an institutional investor in the early 2000s. I think it was 2001 or 2002. So at that point, nobody talked about this idea, and we tried to promote low-vol equity investing as a separate strategy to our core equity strategy. And we traveled to institutional investors and said, well, this makes a lot of sense, having equity exposure with lower risk. Makes a lot of sense. It outperformed historically. We like the idea. However, in what bucket should we take that strategy? So we have an equity bucket, and we report the performance of each equity strategy to our board relative to a benchmark, MSCI or iStoxx or whatever else. And if we buy low-vol equity, where should we put it? I mean, it's a large tracking error. You can outperform, and we have difficulties in explaining this to our board. So we had very little success in bringing that to our investors. And that changed after the financial crisis. I think today the industry and investors, giving the low return environment, giving the high volatility environment, giving the easy access to different strategies, is moving a little bit away from this focus on tracking error as a measure to measure your risk in your institutional equity portfolio. And we are moving, I think, the whole industry a bit forward to having total return and therefore total risk of our portfolio in the focus. And this is, in my opinion, the major reason why there is so much interest in smart beta strategy. So anomalies are known for decades, I think low-vol equity, everybody knows that, was the strategy, especially after the financial crisis. There was some disappointment with traditional managers, computer and data technology, and finally, and Sarah mentioned also that, I think we move a little bit away. We want to understand what drives performance of different asset classes, and this brought the idea of factor investing back into the industry, and this is also something that clearly helped to bring that forward. And as I said, I think it's a perfect naming. I was not aware of finding, I didn't find a source who invented smart beta as a name, but whoever did it, I think we should all give him a lot of grace for naming that. And this is something I see very critical, that there is some promise here for cheap, easy, and transparent access to quant equity strategies and factor exposure. And whenever you think about investing in smart beta, my basic conclusion at the end will be never do it because of historical outperformance. Never do it because of historical outperformance. This is a chart here based on a well-known data set back to 1929. And what I plot here is a rolling 5-year T-stat of 4 of the most well-known factors in academia, but also in the meantime in the industry. So blue is the Asner Strazzini betting against beta factor. So it's basically all 4 strategies are long something and short something, basically with a beta of 0. And the betting against beta strategy buys low beta stocks and sells high beta stocks. We have small minus big, which is more or less buy small firms and sell large firms, value, and finally momentum. And if you look at these, if you look at these, at this 5-year rolling T-stats, you may remember that a T-stat of 2 is something we deem to be significant. So if you have over 5-year a T-stat of 2 of this portfolio, we would say as a quant that this strategy has significantly outperformed or has provided a significant positive return over the past 5 years. And you see 2 things here. The first is this outperformance is very volatile. Factors and factor risk premium change over time. And it's not easy to time when will certain factors and styles outperform and when not. We have done 20 years of research, and each and every quant in this room who has started this for a long time knows how difficult it is to define when value, growth, momentum, low vol, etc. will outperform. If it would be that easy, believe me, if it would be that easy, everyone would do it. And we would not manage 10, we would manage 200 or 300 billion at Quonia. It's not easy to time when certain strategies outperform. And there are a lot of times, when this goes down, when certain factor strategies also underperform and severely underperform. And if you look at the recent 7-8 years since the financial crisis, you also see what's happening here. This is, by the way, the betting against beta factor. So this is more or less the basic of the low vol equity strategy. And you see that just after the financial crisis, we had very good performance in these types of strategies. And it was more or less if you take 5-year rolling T-stats, it was more or less flat. And you see what's going on here. I think that's very interesting when I saw that chart since 2012. So for nearly 2, 3, 4 years, low vol equity strategies showed a significant outperformance, or let me say, equities with low beta outperformed high beta equities significantly. And I would say this is something that is because these strategies have become so popular. Low vol equity investing has become very, very popular. And you see also that momentum strategies did very well over the past years, but that value and size strategies didn't perform really that well. When smart beta came up, and all these index providers offered these strategies, and the question arose within the quant community whether we now are able to blend passive and active components into a very cheap product. And I don't think that this is the right way to phrase it. First of all, genuine smart beta, and Sarah also mentioned that, is a highly active and sophisticated portfolio strategy. And I really mean that genuine smart beta is highly active and sophisticated. So, and there are just three questions here. How is value, growth, and quality measured? If you have 10,000 stocks in a global equity universe and you try to sort them by value, I mean, there are thousands of ways of doing it. And believe me, there are thousands. And when, for example, let me give you a simple example. When we started our firm, a former firm, in the 90s, we didn't have the euro here. And we worked with Panagora, a quant boutique in the US, who did quant equity for 20 years. And they looked at Europe, and they said, well, Europe, you have different countries, so we measure value by country. So we sort each stock in each country by PB, for example, and then we say value is the stock with the lowest or highest, with the lowest PB in each country. And then we came as Europeans and said, well, that doesn't work anymore. Europe is one region, and we need to define value by sector across countries. And we had really a hard time to discuss it with them. So, because they were so focused on this country issue, we were so focused on the sector issues. So this is just one example that it's not easy to define what is value, what is growth, and what is momentum. And even after 20 years of doing research, there are still a lot of degrees of freedoms that my colleagues, that we have researched over the past years, of how to really measure what is a value stock. The second, and even more complicated thing, if you buy low-vol equity, each and everything depends on your risk model. And those of you who had the privilege, for example, to use 2 or 3 different risk models to optimize an equity portfolio, they know what I'm talking about. Each model comes to a different portfolio. And if you do a little bit parameter, change in parameters, you get a different equity portfolio. And those of you who have ever tried, take 100 stocks and just do a simple low-vol optimization. You can do that in Excel today. You know what happens? So 100 stocks, you take just a simple covariance matrix, you try to find the minimum variance portfolio, you will simply end up with the 20 stocks more or less equal weighted with the lowest beta or lowest volatility. So this is not an investable portfolio. Whenever you try to do a low-vol equity portfolio, you have to do a lot of parameters and a lot of things that you have to decide on in building that portfolio. And finally, what's also very important in smart beta is the rebalancing interval. If you have an index, you need to have a clear rebalancing frequency, so half year, yearly, quarterly, and so on. And of course, if you run an active equity portfolio, it's critical how often do you rebalance. It's about transaction costs, it's about how often changes value, what is your turnover, and so on. So these are just 3 things why I believe that genuine smart beta is a highly active strategy. This doesn't say that it's bad to have an index or to have ETFs or something like that. What I don't like is to say suddenly it's a passive strategy. This is not a passive strategy, because I think what I learned when I went to university, that a passive index is easy to replicate, it's transparent for everyone, and there's no discretion, and there are clear rules. And I think most smart beta indices fail in that regard. And therefore, I don't think it's a passive index. And as an index, they also need to be heavily constrained. So this doesn't say, I repeat myself, that this is bad to have all these ETFs and indices, because it make performance of sectors and factors very transparent and very accessible to each and everyone. I think that's very important. But we should be aware that smart beta, in my opinion, is a highly active strategy. And this also explains why low-vol indices and low-vol ETFs from different providers have so different return and risk characteristics. Yes, if you have a DAX ETF from different providers, you may have 5 or 10 basis points per year difference, but this is not really a big issue, But if you have different smart beta strategies, it becomes very, very diverse. Next point is that smart beta is not cheap anymore. This is also something that quants are very much concerned about. Whenever in our industry there is some good ideas and nice idea, there's a lot of money flowing in. And low-vol equity has become such a big issue. It's fantastic. It's really, I think it's a really, by the way, a great way of constructing an equity portfolio. But if you look at basic valuation measures, a standard low vol equity portfolio today is not cheap anymore. When we started that 15 years ago, low vol equity was also cheap. So it was less risk, it was cheaper, and it outperformed it in the past. So, and I think if this is something everybody should be aware of, that this is not anymore a very cheap strategy. And if you look at the performance and of the major of four smart beta strategies over the past years, and this is here the cumulated outperformance versus a standard global index. So this is the Stoxx Global 1800 index, and we have four smart beta strategies. So this is the select dividend, so this is the dividend strategy, and this is very interesting. So at this point in time, after the financial crisis, dividend investing was the dominant investment theme. If you remember, all major asset managers in Germany launched dividend equity funds, and you see that afterwards, most of these strategies didn't outperform at least the global market. It's outperformance, not absolute performance. This here is the low vol equity that did very well after the financial crisis and therefore gained a lot of attraction. This here is the strong quality, and this is the small cap index. Quality really outperformed significantly over the past years, and also small cap. But again, also here you see, this is volatile. It would be so easy if you just invest in factors and get an outperformance. This is not the case. You may have times where you do get underperformance, and you need to be aware of that. Don't buy smart beta because of historical outperformance. Buy it because you think it's a reasonable way to invest. That's my approach in the meantime. If I learn about new strategies, my basic question is, would someone outside the industry to whom I explain the principle would say, this makes sense? Does this make sense? And you think of that, a lot of smart beta strategies do make sense. And I like especially low vol equity. So my summary is, moving away from market cap weighting makes a lot of sense. I think it doesn't make sense basically to allocate capital according to the size of a company measured by its market cap. And low vol equity, for example, I think that makes a lot of sense. I'm a big promoter still, although I don't have any shares in this business anymore. But the idea that I have 10,000 stocks and I allocate my capital in a portfolio that tries to minimize my risk in global equities or in European equities, I think that makes a lot of sense to me. The second point, and everybody knows that, it will be still much more important to decide when to invest in what beta than the decision between smart and maybe dump beta. If you find the wrong time to invest in equities, for example, in March or in April this year, it doesn't make much difference whether you buy smart or dump beta. You will experience a negative total return. So all these smart beta issues leaves the investor, with even more degrees of freedom, not only to decide when to invest in equity, but also to decide in what style to invest, which makes it even more difficult. Who knows how these factors will perform over the next 6 or 12 months? Nobody knows. Like we don't know where the equity market will go over the next 6 or 12 months. So we have still, if you start smart beta investing, you get another degree of freedom. And it doesn't guarantee that the final outcome will be better than without smart beta. So it will be still more important to decide when to invest in what beta than the decision between smart and dump beta. Factor investing. I think the term risk premia is very much too often used in our industry to assume or make us assume that we earn something. If we take risk, there is something we are getting for. Well, this is not the case, you know. This is let me give you an example. I think when we turn back to the CAPM and the market portfolio, the idea of the market portfolio is that it carries systematic risk. Well, what is systematic risk? Have you ever thought about what is systematic risk? Equity is systematic risk. Why? Well, as a society, as a world, we need corporations. And if we need corporations, we need to have some people who give equity, who invest in equity, because otherwise we wouldn't have any corporations. And those people who take equity risk need to be compensated from all the others for taking that risk. This is a systematic risk premium. It needs to be there. If we would all assume today that over the next 20 years, you know, government bonds would outperform equities, why should anybody in the world set up a corporation? I mean, it would be ridiculous. So we need to have systematic risk premia are premia that are out there because they are systematic and because they are important for us. And because they are there, if they wouldn't be there, our whole economic system wouldn't work. So beta, as a sensitivity to the market portfolio, is the example of a systematic risk premium. Size is maybe not a systematic risk premium. Size is something that there are some investors who want to build small companies, and those who invest, you know, maybe it's also systematic because we need to have small companies that become big, but at least it's a little bit questionable. With value, value is not a systematic risk premium. I mean, why should cheap stocks earn a systematic risk premium? So we can go on with that further. So there are risk premia, and maybe investing in small companies, you will get a risk premia. But the question is it systematic? Will it always be there? And will it be there because we need it? And I think you should make a clear difference between these two things, between systematic risk premia and other risk premia. I said that already. Never buy smart beta because of historical outperformance. That may go away, and it will go away. And there will be times where certain factors will underperform. And you cannot, or it's almost impossible to forecast it. And these two things, beating the market is not easy. Whoever tried to do it over a long time, who knows it exactly, beating the market is not easy. The average investor is not dumb, unfortunately. It's very difficult, and it takes a lot of time, luck, and effort to build portfolios to beat the market portfolio because, yeah, the average investor may be not dumb. So my conclusion is smart beta really that smart? I think it is smart. I'm a quant for 20 years. We did a lot of smart things, and smart beta is something smart. You know, selecting stocks according to fundamental data and weighting them in a better way than just by size. I think it's a smart way to invest in equities, maybe also in asset classes. Is it inexpensive? Well, we will see. I think this is a question that we cannot answer today already. I think that genuine smart beta is a highly active strategy and built by smart people. And whether it will be cheap at the end, we will see. Of course, the index providers and all the ETF providers also have a lot of smart people working on these strategies. So there will be some competition between cheap and maybe still quant equity active. And we will see. But as for now, I think that genuine smart beta, maybe I need to say that because I was an active quant, is not cheap. And is it good for investors? I think it's a good tool. It's a better way to diversify your equity exposure. Moving away from market cap weighted indices, it gives you a better risk profile. But don't do it because you expect to beat the market. Just do it because you think for example, that your portfolio has a better structure, you better understand what's going on, and for example, if you have lower equity, you have less risk in global equities or in European equities. That's where my conclusion. Thank you for your attention.